Welcome to Trading Basics Part 2, Lesson number 2. In the last video, we discussed the concept of margin call. In this lesson, we will learn about quarterly reports. Every company reports its key financial data 4 times a year, and the dates for the release of these reports are dependent on their financial calendar year. For instance, if a company's financial year ends on December 31st, like the regular calendar year, then every 3 months, that is, the end of March, June, September, and December, they publish their quarterly reports. The quarterly reports present many key information. This includes gross revenue, net profit, cash flow, and management executive speech that hint on the future direction of the company. So why are these data so important? This has to do with the fact that they could potentially influence how the market reacts. Financial analysts and investors come up with estimates of the key data. These estimates are then compared with the actual data given in the quarterly reports. If the actual data is more positive than the estimates of the analyst, they say that the company beat the estimates, and it usually leads to an overall buy sentiment among investors. Therefore, the stock price of that company will likely go up quickly. Conversely, if the report data disappoints the investors, the price usually falls quickly, sometimes within a matter of seconds. As you can see, by comparing the estimates and the actual data presented in the quarter reports, the market can react differently. Let's take a look at a few recent examples of large changes in the stock price after the release of the company's quarterly reports. This graph shows you the price difference or change in Facebook in July 2018, where it plummeted from 210 all of a sudden to 170, and this actually occurred within less than a minute. In this graph, Tesla's share jumped from $300 to $340 due to a positive production number Elon Musk reported during the quarterly conference call in August 2018. As you can see, the impact of quarterly reports on price is significant. Many novice investors may perceive actual data being better than the estimate profit as a good news to buy, because they think that this means we can have a better or stronger belief in the company's performance and it should invest more. But this is the wrong perception. Even if the report numbers are greater than the estimates, this is not a big buy signal. Experienced investors look at many other factors in order to decide how much money to pour into which company. For instance, the future direction of the company, the turnover of key executives, future growth capacity, potential of acquisition. These many factors could impact how the market reacts and therefore should be taken into account in your decision making. So what should we do as newbies? Newbies and even professionals should not make big bets based on the results of earning reports because many complicated parameters could affect the market sentiment. We also recommend that newbies do not open high-risk positions. This includes stock and options right before the quarterly report's release. Also, be very aware of the dates of the report's release, and if you have realized profit, lock in your cash before the report's release. If you have a long-term investment strategy, be mindful of big price movements every 3 months. So where can we find these key dates? Your broker provides you with all of the dates. You can easily search also in search engines and find multiple sites that inform you of the release dates of the quarterly reports for most of the listed companies on your country's stock exchange. Another great resource is the company's own websites. Most companies that are listed as public companies announce their quarterly reports on their website. Coming up next, we'll discuss short selling. For more educational materials, please go to www.marketnewbie.com and follow us on Facebook as well as our Instagram channel. See you in lesson number 3.